Hello everyone, my name is Prashant Kothari, a CA Finalist. I am someone who is just like you, a student learning about different fascinating topics such as finance, auditing, etc. Being a CA student, I understand the value of financial knowledge among people, even if they are not remotely related to this field. Although I don't think, except for the nuns and monks, anyone else would not be connected to it. As someone has correctly said, that knowledge is like a candle that lights others while consuming itself. With the help of this podcast, I hope to pass on information that I have learned either from my teachers, books, or from somewhere else. I do hope that this podcast will be useful to you as well in your investing life. Let's start with my first episode and the first question. Do you know what are financial shenanigans? No problem. Let me explain. Imagine if someone tried to make their homework seem better than it really is by using some clever tricks. Well, in the world of finance, these tricks are called as financial shenanigans. These tricks involves playing around with numbers in financial statements to make a company's money situation look nicer than it actually is. Sometimes these tricks are small and hard to notice, and sometimes they are big and even dishonest. Just like how you might make your room look cleaner by moving stuff around, companies might move their numbers around to make things seem better. They might make their profit look bigger or their debts look smaller. And in some cases, they might even do things that they are not allowed, like lying about how much money they have or how well they are doing. These tricky practices can range from tiny exaggerations to really big lies. Now, you might want to ask why these financial shenanigans are performed by companies. Well, this is a question that opened the door to a fascinating world of financial insights. In the realm of finance, financial shenanigans are the equivalent of illusions in magic. They are like smoke and mirrors that companies employ to present a rosier financial picture than reality. The answer to why financial shenanigan often revolves around incentives. Just as a magician is driven to amaze their audience, companies are motivated to impress the stakeholders. This could be driven by the pressure to meet earning targets, attract investors, or even enhance the executive compensation. Well, these are not the only ones which are being performed by the companies. There are a lot of shenanigans which I have learned about and I will be sharing with you in the coming episodes. Now, you might want to ask that once we have learned about the shenanigans, how will we be able to identify that a company has employed a trick? Well, identifying financial shenanigan requires a combination of skepticism and analysis. We need to dig deeper into the financial reports, looking for inconsistencies, unusual trends, and red flags. Although I have discussed some topics on my YouTube channel and Instagram handle under the name Stock Market Read, I will be sharing a few examples in this episode as well and will discuss in detail the techniques which I have learned about after reading a few good books in the later episodes. Let me give you some basic examples. First one is about identifying the trends in the financial ratios, such as the current ratio, debt to equity ratio, EV to EBITDA ratio. There will be some sector specific ratios as well, such as inventory turnover ratio for retail business, price to barrel ratio for oil and gas business. Does sound complicated, right? But it isn't. In our country, there may be some specific data sets which are required for some specific ratios. It may not be easily available. But if they are available, it is very easy to calculate and analyze. And it can be made available using some paid legal sources. The second example will be of reading the footnotes properly. Reading the footnotes can give us deep insights into what the formula is used by the company, what assumptions are taken by the company, and what are the changes in the formulas, in the assumptions that are used by the company for showing the profit, for adjusted EBITDA, for adjusted revenue, for adjusted sales. All these adjusted words are very important when you read a financial statement, when you read annual reports. Sometimes companies that don't want people to notice their tricks try to bury the data in footnotes, assuming they won't be read. It is a fact that not everyone reads them. But I believe that the most crucial part of an annual report is footnote. And as a prudent investor, we should always read them. With this, I would like to conclude this episode, and I hope you found it enlightening and informative. I am eager to delve deeper into this subject in the upcoming episodes. As a newcomer to the podcasting realm, I value your feedback, so please share your thoughts in the comment. Your support means a lot to me, and I encourage you to hit the subscribe button to stay tuned for more insightful content. Thank you. Have a nice day.